Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Joe Clark, Founder and Managing Partner. So thank you so much. Thank you, Joe, for joining us this week. Always glad to have you on and let the
So
people hear from you like the old days. Good, at least periodically. So once again, thank you for jumping on. We've got a few points. We've got a couple that are trade related, a couple of these longer term themes that sometimes we kind of go month to month and get data and kind of lose sight of the bigger themes that are going on. I've got a couple of big ones for you that I think are really shaping the world around us in subtle ways, but impactful ways. So we got the first 2 points with China and then services. We're going to talk about trade. And then we're going to go into a more customized and detailed part in the portfolio and talk about alternatives. All right, so we'll start off here with trade with China. Really was one of the central pieces, of course, of the Trump presidencies, and that era really began trade spats with China, probably preceding that just a bit, anyways. But China, believe it or not, which is the light green on here, we've actually had flat trade with going back essentially 10 years. So really to start this trade in this chart and the understanding is to go back to the 1990s. And many of you will remember that NAFTA was the big buzzword, and trade with Mexico was a sore spot for a lot of auto manufacturing workers and the like, as a lot of jobs were being sent to Mexico. And then in 2000s, a lot of them began to go to China. You could see as that light green mark begin to be more and more and more as our trade balance with China just swelled as we were importing cheaper and cheaper and cheaper products, which is one of the factors that really helped keep inflation under bay between 2000 and 2020. Essentially, those 2 decades, we had really sanguine inflation. I think this is one key piece why, but the trade from China has fallen off. And meanwhile, we've seen a resurgence going with Mexico. And many companies, found a catalyst in COVID to change and diversify their supply chains and finding some, actually, in many cases, cheaper labor once again back in Mexico. So, really interesting dynamic there. And number one, I think it helps combat. There's many who are developing an argument that inflation's got a real problem as we move away from this trade from China. So, if it was a beneficiary and it was helping keep inflation low, many are worried what happens as we back off here. But this is one of the levers that could certainly help keep it at least from skyrocketing just due to the trade component. So that's the trade with China here. Moving next here, we're going to just take a look at services. So that's all fine and well. When we're talking about the trade with China and Mexico, we're often talking about goods, TVs, electronics, car parts, things like that. But the biggest piece of the economy in the United States, of course, is services. So anything that's going to impact our overall inflation is really going to have to be focused on the services. So I'm going to Joe jump in here a little bit. Was really to me one of the surprising things, and just as Joe's getting ready here, I'll share why it's surprising to me, and I think important to really stay up to date and adapt our learning to the current environment. Because when I learned economics, all right, it was a long time ago. It was in the 90s. And we were taught that services weren't really tradable. And that made good sense. The classic example they'd give us is you can't get your hair cut overseas, right? That's got to be a local thing. But with a digital world comes change.
and it's so true. And Adam, it's great to be here with you, buddy. We started doing the market cover back in 2007. We've missed 1 week in the last 16 years. So I'm so glad to see this continuing on. And you're going to hear me talk more at the Thirdly. And it's hard in August in Indiana to talk about what's going to occur in the fall, but this is such an important story that I think we grasp. And very similar to your first story, we fall behind what's really happened and get caught up in news cycles. So China, 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 but for 10 years it's been flattening. And when we go back and we talk about goods and services, it was 1954 when the service economy became larger than the goods-based economy in the United States. Now, if you've been in a meeting with me, you know my concern has been about inflation for an extended period of time. We talk in the fiduciary focus about risk and volatility, fees and expenses, taxes today and tomorrow, and that real return is getting something above zero plus whatever the inflation rate is. And looking at the demographic trends, knowing that the older we get, the more we need in services. I have had a bias toward nothing but increasing inflationary pressure in the services sector. And so when Adam shared this with me, it was kind of like, holy cow, another strategic byproduct that actually came out of COVID. And it's hitting out of necessity. And that's really, as Americans, what we are. One of our core values at FEG is adaptable. And it's true of America. We are very adaptable people when we need to survive, very similar to the energy crisis. Again, more on that at the third leg. But moving to this, when you look at services, the accounting industry, the CPA firms we collaborate with, are all in a recruiting nightmare of trying to find workers. So, what do you do when you have 1040s to do and you don't have workers? You got to find out something. And believe it or not, we've got more and more accounting firms using people in India and Pakistan, not foreign speaking, but foreign residing in a much different economy, much lower cost of providing the services, and there's people to fill the need. And we're having our accounting, not in our case, but we're having our tax returns done overseas. Imagine trying to find a tutor, and what it costs to find somebody to be able to educate your young folks if you're trying to get them extra help. How about a PhD for $4 an hour from Pakistan? I mean, it is just phenomenal. And I never thought about that shift. Now, you're not going to hear this, especially in political turmoil, going into a presidential election cycle. You're not going to hear about this for maybe another 5 to 7 years in the mainstream media, no different than the China trade. But the reality is there. We are getting control of some of these service side inflationary pressures from being able to export some of those services in foreign parts of the world, and it just amazes me in terms of how that works. So I'll turn this back over to Adam. Like I said, we're going to hit this again in the third lay more in depth, because I think it is an important part of anybody's financial planning to be able to understand in terms of getting that real return on your money. It really is about purchasing power, being able to buy things. And if you don't understand inflation, I don't care how well you understand investing. If you don't get the purchasing power right, your financial journey's in jeopardy.
Yeah, absolutely, and well put, as always. So those are the 2 points we have for you on trade and inflation. And again, hope you come to the thirdly, because we're going to really hit this, and I think in ways that really impact you, and we'll break that down. We're going to leave you lastly with the role of alternatives in portfolios. One of the things that I love about this business is that there's such a variety, and there's a variety because of each of you watching this. Oftentimes, the stocks that you guys own are similar in the portfolios, the types of bond structures that we have, but the way and the exposures that you have to them are individualized. Every one of you is different, have a different case, and in no way is that more apparent than when we use alternatives. They are not for everybody because of the lockups and the illiquidity and a whole host of things that come with it. But when they do, they are able to improve the portfolio. And when you come in and we talk about this chart right here is a basis for why they enter the conversation. So we've got a whole lot of pie charts here. And so it may look complicated, but we're really looking at something simple. So along the bottom axis for you math majors here is risk. So the further you go out to the right, the more risky the portfolio. As you go up, it is the higher returns. And this is looking back. This is JP Morgan data going back to 1989. So a really long period of time. And along the lower piece of this chart, you see three different portfolios. You see a 40% equities, 60% bond. On the far right, you see 80% equities and 20% bond. And then in the middle, your classic 60-40. But what they show is the inclusion of alternatives is able to do a couple of things. Number one is that you don't necessarily have to go 80% equities to get as high of a return as you've had going back to 1989. In fact, if you just include the right 30% of alternatives, you were able to get that return actually a little bit higher with a lot less volatility. Or on the conservative side, you don't necessarily have to be so weighted towards two asset classes. You can maintain that low risk, but add to your return simply by the inclusion of alternatives. And really a remarkable way and a noticeable way. There are two things that I would say have to be taken with a grain of salt with this, and we certainly think about it when we put individual pieces into the portfolio. One is that during the 90s, there was a wide adoption, 1990s and 2000s, as pension fund after pension fund really began to adopt this 30% alternative business model. So a lot of that extra return may not quite be the same in the future as it was in the past, but we still expect it to be lucrative going forward. And the other is that our business, the registered investment advisor world, the investment landscape has adopted so that these tools to apply these alternatives have really grown. It used to be a highly commissionable world of your large brokers who sold these type of products, but nowadays we were able to apply and implement them on a customized basis for you. So when this comes up in your family update, this is a basis for why you have some of those recommendations. So Joe, if you have any parting words here, we'll kind of make the exit here and close out the session.
Hey, I'm glad you guys take the time. It's not your job to watch the Market Carver every week. It is our job to produce it and to send it to you. If you joined us today, I'm glad you were there. It's always good to be back. Adam and Andrew do such a great job, and Zach as part of that allocation team when he is on here. We will always ask you to send your questions. If there's something you want to know more about, whether it's this team on the allocation side or your advisors, we're more than happy to answer those questions. But it also gives us a format to know what to talk about at the thirdly. If you haven't come in for a next steps meeting, please give us a call at Your Life or a website, obviously, at yourlifeafterwork.com to sign up, or simply give us a phone call. Adam, it's great seeing you. I hope you guys are all having a wonderful summer. And our prayers go out for those in Maui, of course. The world lives in very, very interesting and challenging times. Hopefully, this information was helpful for you in your financial journey. Have a great week.